Right. I want to show you one example of paper one from last semester or last year. You don't have to do this. I don't count off our format. Some formatting, the formatting stuff I do count off on is organizations. So if you don't have it broken up in an organized way, especially no titles, extremely long paragraphs, I do count off for that on the clarity side. You don't have to use two columns. I just think two columns looks more professional with very narrow, two columns with narrow.
You know how I can get this out of here?
And then limit your paragraphs to 10 lines. So, second. Yeah, if y'all gonna come in, make sure y'all mute.
Here, with that thing.
Hugo, you gotta mute, man.
This is probably the only one you all have.
They usually put everything as soon as we get it out.
Okay.
Well, let me click on it. All right, sorry. It's hard to do four things at once here. All right, so, and I also prefer full justify, but you don't have to do that. I just think, I mean, you want to, when you're writing papers, especially if this is not a paper you necessarily would put on LinkedIn, but if you are, make it look as much like it's something published in a financial analyst journal somewhere. Make it look as professional as possible. So he essentially followed the rubric. So he just essentially just goes down, which is not a bad way to do it. And he has the entire section on experience versus exposure. And then he just says page 10 assessment to make sure that's in there. Using the rubric is not a bad way to put it together. He has a conclusion. I don't know what he put in the conclusion other than saying what he's already said. But yeah, I mean, the rubric's not a bad way to go. Make sure you got everything in there. You don't have to, I don't need a bibliography because I'm assuming everything you're doing is from the annual report, except for that extra 10% you're doing on that. You can just put that, you know, you can put a link to the article or whatever you're using. You can just put that in the paper. I don't need a detailed bibliography at the end. If you're not sure, you know, and it's due on Friday. If you're not sure, come by my office hours tomorrow or Wednesday. Or email me and set up a Zoom time. The Zoom time gets a little tougher just because we're running out of time. I'm available in the mornings, but I'm not on a computer, so I can't really read papers, but you can certainly call me if you have questions in the mornings. That's always possible, always open. Any questions on paper one?
You said you didn't want it like an MLA format, right? That's too college paper like.
I don't even know what that format is. So my format is make it look like a professional journal as much as you can. If you don't know
I think MLA will like double space and all that stuff, you know.
Oh, double space is the worst. You should never use double space.
That's how I used to write my English papers.
Oh yeah, it's horrible. Maybe professors want that so they make comments, but who makes comments written anymore? No, double space looks like a college paper. It looks like a high school paper almost. Yeah, I don't know who would. They'll never use double space. And just watch the paragraph links because that really makes the papers hard to read. But you should have titles. The organization of your paper should be pretty obvious just with a 10-second look at it, exactly where everything is and what you're covering. When you have a rubric, the rubric is fine to use. All right. Okay, I want to show y'all a couple of things here. So Wikipedia on catastrophes, we're talking about catastrophes. Wikipedia has a pretty cool website. They show it by costs. And again, this costs, is that insured losses or is it total losses? So this is probably total losses, especially when you're talking about COVID. Very little COVID was insured from the P&C industry standpoint. Maybe it's insured by health insurance. And the number of deaths. So you can see COVID, they're just guessing. There's no way they know what that is. But you can sort it from smallest to largest. So they put COVID as 12 billion, but plus or minus 40 billion. Who knows? I don't know why Chernobyl would be such a high number. I really messed up on the Tokyo earthquake. I've forgotten how many people had died. It's almost 20,000. I didn't remember it being that many people, but it's been quite a while ago. That's a pretty high death rate for a developed country like Japan. You see earthquakes, winter storms can be terrible for lives lost. As far as the property damage, it can be auto related or housing related, but our burst pipes and those kind of things. Earthquakes, they don't have, I don't see Turkey in here yet. I have seen some sites that did have Turkey listed. Obviously, Turkey's death count is going to be one of the highest we've seen in quite some time. Drought, flood. Yeah, I guess there is Turkey. So I guess that's the cost. I don't have it sorted. Okay, so I don't know how they know that's 36,000 yet. They're still finding people now. So you look at Turkey versus, this is, the difference between cyclones and earthquakes. What's the advantage of a cyclone or hurricane is you've got a good 3 months or a good 3 weeks of warning. You see it, and it's going to come over. You don't have that kind of warning with an earthquake. So expect with an earthquake, the lives lost will be much higher than in a hurricane. So if you look at, no, I can't find Galveston. So if you look at the Galveston one, a few thousand lives lost, that's a pretty significant one for a hurricane in the United States. They're going to say COVID's the highest at 6, but who knows where you got that. See, there's the 2004. That was a huge event. 138,000. We look at these numbers. Haiti with earthquake, but it's very different. With earthquake, the property damage is not that high, but the lives lost is huge. So you can get some pretty big discrepancies. A lot of earthquakes. And I don't, this 84, is that an estimate or is that what they know so far? That seems kind of low for Turkey. Turkey's a fairly developed country. You would think the losses there, I think they said there's 6,000 buildings that were destroyed, and you can kind of guess on the math on that, and then 37,000 lives. There's a volcano in Colombia, earthquake, flood, killed 6,000 people, cyclone. But anyway, so who knows who's coming up with these numbers and estimating them. And so on the costs, it's is it insured or not insured, and then is it in 2021 $22? You want it in today's dollars because that makes a huge difference. And here's one that's related to the insurance industry. We're looking at the most expensive losses. This is US. Ike is 40 billion, and I don't know if this is in US and what dollars this is. 1993 floods, 48 deaths. Drought, 454 deaths. I don't know how they get deaths on the drought. $50 billion. Hurricane Andrew, that was a $50 billion loss. That at that time at USAA, that was about our 1 in 500, and we determined Hurricane Andrew is more like a 1 in 50 years. So we knew our catastrophe models are way off. So that was Hurricane Andrew was the wake-up call for the industry. We were grossly under, because we'd gone a long time without major hurricanes. It'd been just this unusually quiet period. And so the models were really understating. And then Hurricane Andrew hit, and we said, wow, that was a really huge event, pretty rare event. They said, no, that's actually not all that rare. We just really miscalculated the numbers. So it was a shock. I think it was 50 billion. So these are not in today's dollars. Irma, Ida, some of these happen all in the very similar areas. Sandy, huge storm, 82 billion. That was a pretty massive one. I don't know how much of that was flood versus actual wind damage. Maria, obviously, Maria hit like more than one place. It devastated Puerto Rico, but also hit in other places. So 3,000 deaths. I don't know how many of those are Puerto Rico versus. And then they had a second hurricane when President Trump went to Puerto Rico and said the absolute worst possible thing you could say, and caused Puerto Rican bonds to nosedive like 80%. I don't know why he would have said what he said. It was like, can you come to our area and say the worst possible things or our bonds will crash? But essentially promised that U.S. was not going to bail them out. Harvey, any of y'all experienced Harvey in Houston? That was probably predominantly flood as well, not wind. That was a big event, 150 billion, but probably if you adjust it for inflation, may not be bigger than Hurricane Andrew because it was, there's a 15-year difference.
I just remember the gas shortage. That was terrible. Remember when you couldn't get gas?
Yeah. Well, and there's a good example. We knew Harvey was coming. We just didn't know exactly where it's going to hit. And so people are trying to flee Houston. So when do you start actually leaving the area? It's tough to make those kind of decisions, but at least with hurricanes, you have that choice. With earthquakes, you don't. But I don't know when people started moving. And then Katrina, obviously, but Katrina was predominantly flood. So the industry did not experience that much. Not the biggest in deaths. I forget, we saw the biggest in deaths not too far back here. So Maria, and some of that, a lot of that could have been Puerto Rico. Usually not as developed areas tend to have more deaths than more developed areas just because the infrastructure doesn't protect from the water as well. So you compare to those earthquake losses you're seeing around the world, especially the number of people dying, you don't see the 30,000 types of deaths or even 20,000 like you saw in Japan. You don't see those as much in the United States. I was listening to The Economist has a pretty interesting article. I'll have to show it to you next time. I have it listed, but the computer is so slow. I don't want to risk it, but just there's some major fault lines that could do the kind of damage that was done in Turkey, but they haven't done anything for 100 years. But that's almost meaningless with an earthquake. 100 years is not much time at all. And there's some that, we could see something like that in Turkey happen in the United States, and they're in areas that don't expect earthquakes, which means the building codes, Turkey's taken a lot of bad press because of bad building. But if you have an area that's not expecting earthquakes, the buildings are probably not going to hold up. And that's pretty freaky, isn't it? You're in a 10-story building that's collapsing, it's a pretty scary thing. And you're asleep, it's at nighttime, it's a pretty scary event. I think far scarier than hurricanes, because hurricanes you can somewhat prepare for them. Have any of y'all been in a hurricane with the wind blowing? Was it category 3, 4?
Well, this was in '89. I was still like 3 years old at the time. See that you would hit South Padre Island. We live in Brownsville. We get something, we get hit pretty good.
Yeah, I've never been in the actual contact.
My grandpa was barbecuing during that though. Outside.
Well, that's the decision you got to make. Do you stay or do you leave?
He has a brick house, so it was pretty safe.
Well, you never really know until it hits because you don't know exactly how. There was one famous story of a guy who decided not to leave from a volcano, and I don't think they ever found him, but he and his pets just got destroyed. So that's the other thing. What is Houston? A few million people. It's hard to get a few million people to leave the city all at the same time. It's just not mathematically possible. So, all right. So there's the cats. So last time we were talking about PML, and we're asking, you have your PML, which you just list all your losses, and then you find that whatever relates to your risk tolerance. If that's greater than your capacity, then you have a few choices. You can reduce the PML with reinsurance, our risk securitization. This is where we're going next to talk about risk securitization. You can increase your net worth by issuing stock. You could try to raise prices because if you had a large loss, that is one thing you'll notice. It's really bizarre. When a major catastrophe hits, you'll sometimes see stock prices of P&C companies go up. So if you have a company that wasn't particularly hit hard by the catastrophe, what the catastrophe will do is going to provide them rate relief from the regulators. And so they'll know they're going to get their premiums approved, especially in a state like California, if you have a major event. And so you'll actually see some that if they got hit really hard, they'll be offset by the losses. And you can always debate the model. How good is the model? How accurate is it? And these things are plus or minus, who knows what, because they're just guesstimates. Especially earthquake, because earthquakes are the harder ones to forecast. And then you just keep adding more cushion. How much cushion do you need? The rate agencies look at it like they do any other probability, and they're asking, what's the probability of you going under because of a catastrophe? And they compare that to the probability of a AAA or AA company going insolvent. And they want that kind of cushion. And you almost can't have enough in the P&C industry because there's a lot of uncertainty. That's part of my challenge with the CEO I had, is he wanted so much net worth. And it's like, we're building up these massive amounts of net worth. It just makes you uncompetitive because you got all this money just sitting there. So it is a challenge. All right, I think we did both of the examples. So how many scenarios do you run? Do you run 1,000 or 5,000 or 5 million? How many do you run? And that's this key concept of convergence. I don't know if you actuaries use this term at all. But what convergence is saying is you want to run enough simulations so that the simulations around your risk, your PML are real similar. You don't want jumps. So you run the model multiple times, determine the PML, and then you run it again and see if the PML is still about the same. If it jumps, you need more scenarios. And we're talking about very, very rare events. I mean, like at USAA, we're running a 1 in 500 year event. You can't run 1,000 scenarios if you're trying to find a 1 in 500 year event. You have to run tens of thousands, if not hundreds of thousands, if not a million. So you want to have enough simulations so that your PML says, I mean, assuming you're running the exact same model over and over again. Obviously, if you're changing the model, it's going to change. But if you run the exact same model over and over again, you should get very similar PMLs each time. So you don't want large skips. Run enough simulations, but no more, because this stuff is expensive. There's some of the models reran. I mean, literally, I'd kick them off Friday morning and they'd still be running Monday morning when I got back to the office. They can run for a very, very long time. Maybe not so much today. I think computers are probably getting much faster today, but it can take a while. And we had distributed processing, so I might have been using 20.
You're so mean. Why do you have to be mean to me when I try? I'm your girlfriend, not some stranger. I mean, you should put this in a picture, right?
I shouldn't.
Muting myself. All right. And actuaries, this is what they're good at. The challenge we had at USAA is we were running multiple businesses. The bank said 100 simulations is more than enough for us. The life insurance company said, 1,000 is more than enough to us. And then the P&C company said, we need 1 million. And so we had all these different groups. And then the P&C actuary said something I thought was really interesting is, let's run 1,000 and then we'll just take the tail and we'll run the tail 1,000 times. So they're essentially saying, let's do the distribution of the tail. Then we don't have to run 1 million simulations. We can just run 2,000. I don't know if they ever got that to work, but that seemed pretty intriguing to me. So, you run 1,000 scenarios for everything, and then you run 1,000 scenarios of the 1% of the distribution. So yeah, it's kind of interesting, but P&C companies need a lot more simulations than a bank, because a bank is a much simpler institution, doesn't have as much tail risk as a P&C company. But you want to be parsimonious. You want to make sure you run enough, but no more, because it's expensive. It's a lot of computer time, very time consuming. All right, so that's how it works. If you're an actuary, there is an actuarial department that does nothing but deal with catastrophes and reinsurance and risk securitization. So there's a guy named Kirby at USAA, and that's what he did. Kirby and Mary and Melissa, I forgot her name. Those two is a small department, 2 actuaries, and they ran these models. They worked on the companies that ran these models, and then they determine reinsurance and the securitization. So I want to go ahead and do securitization now since we're here. And you'll find it on Blackboard under miscellaneous materials. Securitization examples. So let's do this. We'll come back to reinsurance later. I wanted to show y'all some real life reinsurance charts, but they're very proprietary, so I can't get them online. I found some that weren't really good, but it's the only ones I could find. I really wish I could show you what USA did, because it's really fascinating, but there's no way they would share it with me. Maybe I could ask them to share it with me, but they distort it, so it's not the real thing, but I'll show you some. I think I wrote this when Jeremy Lin was killing the NBA. Y'all remember him? So I think that's where this came from. All right, so let's look at this. Pretty famous for San Antonio because USA is the one that did the first one of these. So USA worked with some investment bankers and came up with the first catastrophe bond. And so we're going to actually do one in class. I've simplified it because they can get quite complex. I simplified it. We're going to do it for an earthquake, which means we're going to issue the bond and the earthquake's going to happen immediately. Otherwise, if there's time delay, it gets confusing because you have to invest the bonds and make interest on the bonds and all that. So I couldn't do this with a hurricane because there's no way you're going to issue the bond and a hurricane happens tomorrow, because you're going to know it's out in the ocean by that point. So being earthquakes, it's going to hit immediately. So they're going to issue 2.5 billion in catastrophe bonds. Now I'm being real sloppy on the. Let me explain these things here. So I'm being really sloppy on my terminology. So I said they. So who is they? So let's be real clear on this. We got the insurance. My word, Bill Gates, why would I switch fonts? You got the insurance company. You've got a trust, and you have investors. When I say they, I really mean the trust. All right, so I'm being sloppy when I say they. A lot of times it sounds like the insurance company and the trust are the same thing, but they're not. They're 2 separate legal entities. So I'm going to try to do it the way USA would say it, because USA was real picky on this. USA would never say they issue catastrophe bonds. They don't issue catastrophe bonds. The trust issues catastrophe bonds. That's not USA. That's some separate entity. They don't have anything to do with it. But then if you go out to the internet and you do USA cat bonds, they issue cat bonds all the time. USA returns, does that look like USA is doing it? USA returns for 40th catastrophe bond. USA targets 375 million residential RE. That's that trust, Res RE. I'm going to give y'all some inside information. For USA, they call it Residential Reinsurance Company. They call it Res RE. So this is USA. It is not a subsidiary, so I assume you put USAA. There is not a subsidiary of USAA. From USAA standpoint, this is an insurance company that reinsures companies. It just happens that they only have one customer, and that's USAA. but USA doesn't own them. It's not consolidated on USA's books, although the auditors debated that. But so I'll say USA's reinsurer. That's the way USA says it. But for some reason, they can't get the articles to go along with that. So this one's kind of strange that USA targets plus Res Re cat bonds, but USA and Res Re are not the same entity, but articles tend to write that. Okay. So there's this trust, there's this insurance company that USA buys reinsurance from, and this trust goes out to investors and they issue catastrophe bonds, also known as cat bonds. They issue them to the investors. And they provide reinsurance USAA. So that's what the trust does. It's this entity set up. It's also known as an SPE. Anyone know what an SPE is? That's a good term to know. If you go into an interview, anybody heard that before? Any guesses? So it's kind of a bad word these days, but it's known as a special purpose entity. Does that sound familiar? The reason I call it a trust, it's been established for a very specific reason. It may not technically be legally a trust. It's technically a special purpose entity. We don't like special purpose entities because there's a firm named Enron that had a few of these special purpose entities that did not necessarily turn out so well. And that was part of the issue is Enron had these special purpose entities that were taking a bunch of bad stuff and getting off their books. And the auditors that messed up with Enron should have consolidated those on Enron's books. So now auditors say, hey, maybe Res Re should be consolidated with USAA, but they've won that argument. It's not the same entity. All right, so be real careful on this. When I say they, I make it sound like it's the insurance company, but there's other entities involved here. All right. And I got a YouTube that works through this math if you want some practice. And then you'll have the problems we work in class on the YouTube as well. So essentially, I'm going to do USA terms, all right? Res Re is going to issue a $2.5 billion 5-year catastrophe bond. It's going to pay a coupon of 4.8%. And it has an attachment point of 900 million. Attachment point is nothing more. Just think of it as the deductible. So they're going to pay a coupon of 4.8%. They're going to get $2.5 billion today because they're going to issue the bonds, right? Res Re or Lynn is going to borrow $2.5 billion, and they're going to pay 4.8% to the lenders. But they're going to stick all that money in the treasuries, and treasuries are only making 2%. So if they got a problem, they've got $2.5 billion in bonds, and in 5 years they got to pay 4.8%, but they're only going to invest at 2%. So they're short some money. Who do you think is going to make up that shortfall?
Insurance.
Yeah, the insurance company. And how are they going to make it up? They're going to pay a premium. Res Re. So this is, if this was USAA. So from USA standpoint, they're just buying reinsurance from an insurance company called Res Re, and they're going to pay a premium. How much of a premium are they going to pay? Enough so that Res Re can pay that 4.8%. Okay. So I give you the steps in here that you're going to calculate. So the first thing you're going to figure out is the return the bondholders will receive and what Lynn will make under these following scenarios, okay? 550 million, a billion, and 4 billion, right? Remember the attachment point is 900 million. So you can almost guess if the losses were only $550 million, what is ResRe going to do? Not going to do anything. They're going to pay their bondholders 4.8% because you're under the attachment point. So as long as you're below the attachment point, it's real simple. The insurance company, USAA, is going to pay the full 550, and the bond investors are going to make their full 4.8%. It's only when you go above that attachment point that the insurance company gets something and the bondholders are going to lose something. So this is what a cat bond is. It's an interesting thing. It's a securitization, but not a securitization of assets. It's a securitization of liabilities. So let's real quickly, I think I have it in the notes, so maybe I can go back. So what is securitization? It's an important term to know. I may have it even better in the notes down here. So let's talk asset securitization, and then we'll do catastrophe securitization. But it works very much the same. You have, with securitization, you have three parties as well. You have the bank, you have the trust, and you have the investors. For catastrophe securitization, you have an insurance company, the trust, and investors. All right, there's three parties. So for asset securitization, you probably handle this in some of your classes. You're going to take something that's not a security, and you're going to make it into a very liquid security. That's what you're trying to do. So a non-traded asset. Have y'all heard of this term before? ABS, asset-backed securities. Does it sound familiar? You can certainly Wikipedia that. But banks have these assets they don't like. Mortgages, home equity loans, which they don't do anymore anyway, credit cards, auto loans. They'd rather have their money now. They don't want a 30-year home mortgage. You know, they have 2-year CDs, 3-year CDs. They don't want a 30-year asset. That doesn't make sense. But they're the go-to place for people to get mortgages. And so they got all these mortgages, but they don't want them. And so they go out to the market and say, hey, you know what? We got like these 100 mortgages here. If we stick them into a trust and borrow against them, we'll get our money today, and the market, whatever these mortgages do, the market will get that. So what they're going to do is they're going to take all these loans, place them into a trust. That trust is going to borrow against those loans. And as those mortgages pay off, they'll just pass that on to the investors. So these are called mortgage-backed securities. You have credit card-backed securities, auto loans, bank loans, CDOs, CLOs, just any contractual cash flow that's not very liquid. You can stick it into the trust. That trust can borrow money against those assets and then send them money. So it's kind of a way for the bank to get their money today and not to wait 30 years. They get it at a discount rate. I mean, you have to take the present value of it. So that's the way asset security goes. I'm sure Wikipedia would give you some pretty good information on that. It's mainly related to banking. Banks are real popular. USA's bank, it was 15-20 billion dollars of this every year. It's pretty straightforward. There's a bunch of them. Asset-backed securities is the high level. That includes everything, but you have mortgage-backed, collateral debt obligations. There's all kinds. And so essentially what the bank is doing is taking a bunch of these illiquid assets, sticking it into a trust, and then that trust creates a very liquid bond security. And just those assets become not just collateral, but they actually just pass on their cash flows. So as you pay your mortgage, that doesn't go to your bank. I mean, your bank's going to take it and give it to the trust, but it's going to go to the trust, and the trust is going to send it to the investors. I don't know what all they have in here. Yeah, credit enhancement and tranching is pretty popular. I don't think that's popular with cat bonds. And then what does the bank get out of this? They still get a servicing fee. So they're still doing a lot of legwork. They make a little bit of money on the side on these, but essentially they get these assets off of their books. It was interesting at USAA because USAA had, I think, one of the fastest growing banks in the entire country there for a while, but you couldn't tell. their assets were growing very fast. And that's because they just kept putting these assets into a trust. They had to do $20 billion of auto loans and mortgages, but they get them off the books and they just disappear. So they could have been, 2-3 times the size they were if it wasn't for the securitization. So that's what securitization is, but that's asset securitization. Can we do the same thing with a liability? And that's that is what a cat bond is. And you see here, their 40th catastrophe bonds. Wikipedia, I think, has a pretty good section on catastrophe bonds. Cat bonds. I don't know if USA is in here anymore. USA was in here at one point. Let's see, history. There it is. The first experimental transactions were completed by AIG, Hanover Re, St. Paul Re, and USAA. The USA even has its own Wikipedia page. Do you think USA watches its Wikipedia page and monitors it? All right, so yeah, so USA is actually, part of this history. So how do you take securitization? So it's a little bit different. There's so the way a catastrophe bond, I call them cat bonds. I made a mistake of when I met Dr. Emerson the first time. I asked him about cat bonds and he had no idea what I was talking about. Catastrophe bonds, fairly new thing. Doesn't look the same as asset securitization because you're not taking a liability off the books. You're taking a potential future liability and converting it into a very liquid thing. All right, so the best way to do these is just to do an example. So just go with me on this and you'll see the math. This looks real familiar. Some of you took my life insurance class last semester. We did equity linked annuities. The math works very similar to those, if you remember that, but I don't think many of y'all were in that class. So we're gonna borrow $2.5 billion. And in 5 years, we better have 3,160.43. That's 2.5 billion. Y'all know this math here. 1 plus 4.8% raised to the 5th. We're just going to take the future value of that. So at the end of 5 years, we better have 3,160.43. Our bondholders are going to be really upset. But we can't invest at 4.8%. We can only invest at 2%. So we take the present value. So we need 3,160 in 5 years. But that discounted at 2% is 2,862.50. How much money are we getting from the bond investors? They're only giving us 2.5 billion. But we need to invest 2,862. So how much do we need from the insurance company? We need 362 million from them, which is going to be their premium. All right. Everybody see so far how that works? All right. So first thing, step 1, take the future value of the amount you issued. Step 2, take the present value of that at the rate you're actually going to invest in. The difference between that present value and what you're actually getting today, that difference is made up by the insurance company. And they're going to take that 362 and they're going to invest it along with the 2.5 billion at 2%. And at the end of the 5 years, they'll have 3,160.43. Questions on that? Now, I don't know if USA notices like that. They just see the premium. And I don't know who's doing all this because they were never allowed to talk about it. I asked all kinds of questions. They're like, we don't know what you're talking about. Yeah, we don't have anything to do with that company. If they did ever talk about it, they would get on a plane and fly to Bermuda. A good friend of mine, Paula, she did that. I said, wow, that's so good. Cool. You get to go to Bermuda. Yeah, I get to fly to Bermuda airport and we meet in a conference room in the airport for 5 or 6 hours. Then I get on a plane, I come home. It's not the most exciting vacation in the world. I never leave the airport. Why did they go to Bermuda? Because they can't be on US US soil. So it's not all that exciting, but yeah, it's very arm's length, very hush hush. Which is maybe one of the reasons they don't correct these articles, is they just don't want anything to do with it. So on day one, the trust has 2,862,50, 2.5 billion from the lenders and 362 million from Lynn. With that amount, they're going to invest at 2%. Okay. Now you got to get that part right to get to this section here. So hopefully you're comfortable with that. But we got several examples and we'll work more than one example. So you'll start getting used to the math. It's just the same thing over and over again. So let's try the first one, a $550 million loss. Well, if the attachment point is 900 million, then it's pretty straightforward. The insurance company is going to pay the trust 362.5 million in premiums. They're going to have losses of 550. They're going to lose 912.50. If they'd known that this was the case, they wouldn't have bought the reinsurance, because they didn't get anything out of it other than paying the huge premium. All right. What does the bondholder get? They get 4.8%, right? Because they hit the attachment point. So what do you think these bonds are doing? And one of these days, I'm going to have to get one of these bonds. You can find them on Bloomberg. What I want to do is, when Hurricane Harvey is in the Gulf of Mexico, I want to pull one of these bonds up on Bloomberg and watch what it's doing. What do you think its price is doing? Is it falling 5%? Is it 10? No, this is the bond. So if the loss is more than 900 million, the bondholder is going to lose a lot of money. And I'm looking at the bonds. So what's this bond doing when Harvey's in the coast? It's going to be nosediving. But how much? And that's what I don't know. Is it going to fall 10%, 20%, 50%, 80%? You know, these bondholders, they're watching real closely. They want to know the path. If it hits between Corpus Christi and Midland, no one cares, right? 6 cows die and no one cares. But if it hits Corpus Christi, if it hits Galveston, you know, there's a lot of land in Texas where there's just nothing there. You know, King's Ranch and all that, it's a real pretty area, but you know, it's desert and a bunch of cows and like 7 trillion rabbits. Have you ever driven in that part of Texas at nighttime? It's like a video game. I mean, it's just rabbits constantly. So a bunch of rabbits would die, but not much else. So you're watching this thing and you can see that you've seen those funnels, right? If it hits here, it's going to be 3 billion. If it hits here, it's going to be 10 million. So the bond's going to be pretty volatile. But now we know the loss was only 550. The bondholders have a sigh of relief. And I'm even tempted, looking at those bonds, that maybe you buy one at that point. Say, wow, it's dropped 80%. You know, if it hits, then, you know, yeah, maybe I'll lose 50%. But if it doesn't hit, I'll make 500%. That sounds like a pretty good odds kind of thing. So, all right. So the bondholders are going to make 4.8%. So the way you have this set up if a loss happens, it happens the day 3 seconds after the bond's issued, but then there's no other losses for the next 5 years. And most of these, it might be a 5-year bond, but the insurance only lasts for a year. So after you get past a year, the bond's just a bond. It looks like a treasury security. Very, very safe, no risk. So here they have a loss of 550, and then there's no more losses over the tenure of the bond. Now let's do the $1 billion loss. So how much is this above the attachment point? Someone just say it, so I know you're awake. 100 million, right? So $1 billion versus 900. So the trust has to pay 100 million. You see why I had the loss happen immediately? Because if it happened 6 months from now, you'd have to accrue 6 months of income, and I don't want you to have to do that. So I haven't, but you could handle that, right, if you needed to. But there's no reason to do all that math on the exam, so I'll just have it happen immediately. So there's $100 million loss. So the trust has $2,862,000,000, but they got to pay $100 million. So they only have $2,762,000,000. The $2,008,000,000 that they got, the $2,005,000,000 from the bondholders, the $362 from Lynn, they have that they're going to have to send $100 million back to Lynn. So they only have 2,762,000,000. They're going to invest that at 2% for 5 years. So at the end of 5 years, they're going to have 3,050,000,000, not the 3,160,000,000 that they need. And so what is their return? They're going to have 3,050,000,002 divided by the 2.5 billion that the bond investors invested. Raise that to the 1/5 minus 1. The bondholders are going to make 406% versus the 4.8 they wanted. Now, did this bond default? No, because this is part of the bond. The bond did exactly what it promised, so there's no default. It's just that they had a catastrophe, and so the bondholder is going to make 4.06. Do you think the bondholder is upset here? They're probably going, all right. So that hurricane could have been a lot worse. The return went from 4.8 to 4.06. Right. So if you want to look at it in steps, step 1, what did I do? I took the loss minus the attachment, and I got the net loss the trust pays. All right. Step 2, I took the amount trust started with, minus that net loss, that equals the net amount to invest. Step 3, I took that net amount times 1 plus the treasury yield raised to the n, and that gave me the future value. Step 4, I took the future value over the bond investment raised to the 1 over n minus 1, and it gives the bond holder return. So those are the 4 steps I did. Which of these steps are you not sure about? What is this number here in our example? Is it 2.8 billion or 2.5 billion? 2.5 billion. Because we're only interested in the bond investors. They didn't give us 2.8 billion, they gave us 2.5. Lynn gave us 300. All right. So those are the steps you want to do. So the trust had 2.8 billion. So we took the loss minus the attachment point, that gave us 100. The trust started with 2,862.5 minus 100. That's going to give us 2,762.50. We take that to 762.50 times 1 plus 0.02 raised to the 5th, and that gives us 3,050.02. And then we take that 3,050.02 divided by 2,500,000 raised to the 1 5th minus 1. We get 4.06 or something. Got 406. You see where I got all the numbers. It's really, really key that you see where every number is coming from. And if you're not used to doing this, this is the formula you will do more than any other formula you'll do in finance. Present values, taking things to the 1/5 power, pretty common. So make sure you're getting 406 in your calculator. You can't use Excel on the exams, so make sure you can do it on your calculator. I don't use calculators ever, so I always have to find that X of Y of X key somewhere. No questions on that? All right, so the bondholders are going to make 406 instead of 4.8. What does Lynn pay? Well, they have the premium of 362.5. They pay the full $1 billion loss. These are their customers. It's not like they say, hey, part of this is gonna be paid for by the trust. No, they have to pay the billion. And then they go to the trust and say, pay us everything over the attachment point. So they're gonna pay 1,262.5. Which is only $100 million less than what they paid. I mean, it's only 100, they're only making out 100, so they're still worse off than they would have been if they hadn't bought the insurance. They would have only paid $1 billion if they had not bought the insurance. All right, everybody see that? Fortunately for the catastrophe bonds, when these things were first issued, we'll talk a little bit more of that than them, but they were oversubscribed, which is good because you do something new, you're wondering if anyone's going to buy them. But then real fortunately, the first several years they had these, there was no major catastrophes. So the bondholders didn't lose any money. So they were really happy. Can you imagine if the first one they did, you had a major hurricane? I mean, you think about it, some pension manager says, hey, we're doing these new cat bonds. And then the first year they do it, they lose 100%. Their boss is like, wait, why did you have to be first? But fortunately, we went several years without, and I don't know what the losses are historically. This could be a great paper 2 topic for someone because I really don't know the math here. And I don't know what's out there. I don't even know if it's possible to get the information on these bonds to know how much has actually been lost by some of the major, how much did they lose on Harvey? How much they lose on Maria? It would be interesting to see. All right, let's do C. So a $4 billion loss. So how much is that above the attachment point? The loss minus the attachment points. So we got 4 billion minus 900, $3.1 billion. You take the amount the trust originally started with minus 3 billion. How much is left? Zero, because they're not going to go out to the bondholders and say, hey, we need more money. So once you use up their 2.5 billion, they're like out of the game. They lost all their money. So what's the net amount that you're going to invest? Just the math gets kind of easy here. 0 times 1 second. It's 0. What is 0 divided by 2.5 billion raised to the 1/5 minus 1? And don't say 0. What is it? It's not 0. How much did you lose? You lose 100%. All right. So the return, they wish it was 0, don't they? They wish they could get their 2.5 billion. They've been happy with that, but now they lose everything. And that's when their boss is like, why did we do that? But we'll talk about why would they do this, because these bonds did extremely well in 2008. They're one of the highest returning. They didn't do as well as treasuries, but they were one of the highest returning bonds in 2008. You think the boss was kind of happy in 2008 when all their other bonds were down 15% and these bonds were doing really well. All right, so you work through, the trust pays the entire 2.862 billion to Lynn. The bondholders lose 100%. Lynn pays the premium. They pay the loss. They get 2.8. So they end up with 1.5. Where does this 1.5 come from? You knew that's the best they, it's just the 4 billion minus the 2.5 billion. The most they can get out of this is the 2.5 billion because that's all the new money coming in. So if the loss was 4 billion and the bond paid 2.5, they're essentially going to cut their losses by 2.5 billion. So if they hadn't done this, they would have lost 4 billion. Because they did this, they only lost 1.5 billion, which is the 4 billion minus what the bondholders provided. So what is the rate on line? Anybody remember that one from earlier? Remember when I did auto insurance? I said, how much more was the premium? versus how much more coverage did I get. So remember, if you went from a deductible of 1,000 down to 500, how much extra coverage did you get? $500. How much more was your premium? Take that premium or extra coverage. So here, how much more was the premium? 362.5. What's the max extra coverage they're getting? 2.5 billion. That would be your rate online. All right. I love rate online. I think it's a really, really good way to think about coverage. All right, we'll do another example here, but let's talk about these bonds just a little bit because so who would then this is the question we had on these is who in the world is going to buy a catastrophe bond? It's just its title is pretty horrible. Hey boss, I want to buy this thing. It's called a cat bond. What do you mean a cat bond? Yeah, it's a catastrophe bond. What is you mean we make a lot of money if there's a catastrophe? No, if there's a catastrophe, we'll lose a lot of money. Why are you doing that? We're betting on hurricanes not being as bad as they could be. Just the whole thing, the whole conversation, your boss is like, wait, what are you telling me? So why do you make an argument for this? It all comes down to low correlation. You've got something that is uncorrelated to the overall bond market, stock market. Now, could it be correlated? Is it possible a major hurricane could cause the stock and bond market to crash? If you go back to Tokyo and their earthquake and tsunami, yeah, the Japanese market did have a major hiccup, but it recovered pretty quickly. It sold off and came right back. So, you know, maybe the correlation is not as close to zero, but it's close enough to zero that you're getting some pretty good diversification. It's hard to find this high quality of diversification out there. It just doesn't exist that much. The other thing is these bonds are pretty lowly rated. These are not AA, AAA, single A bonds. They're usually BBB or BB bonds. What the rating agencies look at this is not the probability of default because they're not going to default. They're going to pay according to the bond. But what they want to do is look at the probability the bondholder doesn't get all their money back relative to other bonds, that probability, and they want to equate it. So they're trying to size this up as any other bond's probability. And so these bonds pay pretty good yields. They're competitive with other BB rated bonds, but they're completely uncorrelated to those other types of bonds. But after the coverage period, they're just treasuries. You know, once you're past what you're covering hurricanes, because the trust is just buying treasuries, so you have all your money. So it has a high expected return due to the low ratings, but you're getting tremendous diversification. Now you might say, well, how reliable is this probability? Well, you know, you have the same type of statistics for any kind of bond. What's the probability a BB bond is going to default? You look at history, you look at the industry, you look at S&P and Moody's and their models. You know, there's a lot of uncertainty on anything. You know, they messed up royally on Enron. They had Enron rated AA the year Enron went under, so they can make mistakes. So you have that uncertainty any kind of bond you buy. You might argue these bonds have a little more statistics behind them than some other bonds because you're not worried about the Enron, you know, someone hiding stuff and fraud and all that. You know, these are actuaries. They're going to give you the numbers. But it's an interesting new bond and did really, really well. And I don't know if, you know, these articles talk about how oversubscribed. This is just back October 2022. UTSA, the primary mutual fund insurer, I don't know why it says the U.S. primary mutual, I don't know what that means, has returned to the cat market with 150 million Res Re. That will be its 40th issuance. And as the first cat bond since Hurricane Ian, the deal provides the first glimpse in the post-Ian price environment. When did Hurricane Ian? Y'all remember Hurricane Ian? That was just last year. Y'all remember that? Is Ian a male name or a female name? It's male? Okay, we'll talk about that later. Does it make a difference if the hurricane's name is male or female? Where are the losses higher? There is a statistical difference. Do y'all know?
Female.
The female's right, but why? Why are there more losses when there's a female hurricane than when a male hurricane? Okay, we'll get into that. Yeah, y'all really want to know though, don't you? There is a reason. I'm not making this up, and there's an article written about that. All right, so investors like it. It's a good diversification. It's got a good return because it's a low rated bond. You only have about a year to worry about it, so it's not like a 5-year bond. So the insurance only lasts for about a year, even though it's a 5-year bond. You only have to worry for 1 year, and if it's a hurricane bond, you only have to really worry for like 3 months, because hurricane season, once it gets January, February, you're not going to have a hurricane, and when it's cold, so you only have a few months to worry about it. So once you get past November, you're really out of the woods. So that's better than lending money 5 years to a double B name, because you got exposure for 5 years. So it's got a lot of good qualities to it, and these things have been oversubscribed. Catastrophe arms as a form of reinsurance have become a staple of USA's reinsurance tower, and USA is back. So this looks like it's written by USA because it's Cayman Islands. I guess I got it wrong. It wasn't Bermuda. Special purpose vehicles, but I call it SPE. USA is seeking 150 million or more in multi-year and multi-peril catastrophes. So they're going to go out more than a year, multi-peril. So it's going to be hurricanes, earthquakes, whatever. As is typical with its fourth quarter cat bonds, that tends to be finalized and issued in November. Treasury Limited will look to issue 2 tranches. You know what tranches are? So tranches, you've heard the word tranches. So with mortgage-backed securities, you might have a tranche that protects you from prepayment risk. So it's more highly rated, but a lower yield. So essentially what you can do is you're going to try to break it into a high risk piece and a low risk piece. A high risk piece, boy, if this hurricane hits, they're in a lot of trouble, but they're going to have a 6% return instead of 4.3 or whatever. So that's what tranches are. Tropical cyclones, earthquakes, thunderstorm, winter storm, wildfire, volcanoes. I don't know where we have members with volcanoes, I guess, Washington State, meteorites, other perils. Class 3 notes will have an initial base expected loss of 2.7, would attach at 2.3 billion. That's a pretty high deductible, isn't it? Any of y'all have a 2.3 billion attachment on your auto insurance? So that's a big.
Yes, sir. I remember I read, was it Mount St. Helens was pretty serious too?
Yeah.
I was really serious.
But how many houses are right in that area? So it's kind of where I go in Costa Rica. They have volcanoes, and they've had in fact, there's one trip the week before we're flying back, they actually had to close down the airport not because of the volcano, the lava, because of the ash in the air. The planes couldn't see. So volcanoes can be pretty destructive.
They say Yellowstone's gonna blow anytime. I don't know what that's just.
Yeah, but those are pretty remote areas. So the property damage is what insurance companies are worried about. Will probably be somewhat limited.
Right.
Look at these returns. Those are pretty hefty returns.
So are these specifically for aggregated losses for the year?
Yeah, that's what they're saying here. This is multi-peril, I don't know why it says multi-year, because I don't remember them going out more than a year, but I guess it's possible they could go out 2 years. They have a class 5 with much lower returns, but look at those. That's tempting, isn't it? 10%. Can you make it a year without we've made it a decade without a major event? Because you make it 1 year, it sounds like you got a pretty good chance at a 10% return. You got a chance at a negative 100% return. But this could be a paper topic. I just don't know how much data you could get out of this. So what's in it for the insurance company? Well, what USAA was looking at was the reinsurance industry was consolidating. Swiss Re, Monarch Re, they were all buying each other. You have, is it Gen Re at Berkshire Hathaway? you're down to just 2 or 3 major companies, and USA is like, that's too much exposure. We can't have everything with Swiss Re, because if we have a major catastrophe, they could go under and we have no reinsurance. And so this is a way for USA to get more reinsurance capacity outside of the reinsurance industry. Now I had this idea, I don't know why I'll come back to this, but cat bonds are more expensive than reinsurance. So they'd rather do reinsurance. It's cheaper. The rate on line is going to be lower, but cat bonds are less risky because the cat bond's sitting there in treasuries. So if you have the catastrophe, you're going to get paid. Versus reinsurance, if the reinsurance goes bankrupt, you're out of trouble, right? They're just an insurance company. So it makes sense cat bonds have a higher rate on line because they don't have as much credit risk. But even with the credit adjustment, these are expensive. But USA has continued to do this because they just like that capacity. They like to have it just in case something bad happens to the reinsurance market, they have it. Now I had an idea at USA, but I never could get them to listen to me on this. But what if, y'all heard of credit default swaps? What if USA sold credit default swaps on a general bond market and bought CDS on reinsurance companies? And I thought that might be a good way to hedge this risk, right? Because if you buy a CDS on reinsurers, if they go default, the credit default swap is going to pay you off. Selling CDS on the general bond market, USA does that anyway because they buy corporate bonds all the time, so they already had that kind of exposure. So, you know, I don't know if it's possible. One of the issues might be that reinsurers don't use the bond market that much, so there may not be a CDS market on them. So that might be a challenge. But this is an issue. The reinsurance industry is very concentrated, and it is frustrating for insurance companies that are just running out of capacity. So what did they do with cat bonds? They just added a few $1 trillion of capacity in the entire capital markets. Not that they're using that much of the market, but they just greatly expanded, and they don't worry about concentration because it's sitting there in treasuries. So it's an incredible win. I don't know if we can, you know, cat bonds, they say history here. A typical corporation is rated as probably default. A cat bond is rated based on its probably default due to a cat triggering event. Are rated below investment grade, double B and single B. And I don't think, you know, they're not looking and saying, oh, this is really the USA, so it's higher quality than if it's someone, you know, they're looking at the insurance. They're not the insurance companies. So it's very much is the model. And maybe USA gets a break because they trust USA's cat models better or their actuaries better. So there is a little bit of a marketing on this. Yeah, one of y'all might want to do a paper on this. There might be enough. I think what we'd have to do though is say historical cat bond losses and see if you could actually get anything. It looks like there might be enough for a paper here. It'd be a very interesting paper because it's a really interesting asset class, and it would give you something interesting to talk about in an interview. So you might think about it. There might be enough out there to really go with. I don't know if it's telling you which specific event kicked it over, but it's cool that it actually has links here. I don't know what happens if you click on the link. There's Res Re, so we'll do that one. Hurricane Harvey. Wow, this almost want to just, yeah, I'm glad I saw this. Wow, it's pretty cool. All right, so next class, what we'll do is we'll work another problem. If you want to work it in advance, it's the Taylor Company, and I don't remember who Taylor was. The Taylor Company. So if you want to work in advance, don't look at the answer and just practice a little bit. So you'll have it. So we'll do this one next class. All right. I want to do another one of these problems just to give you some practice. Now you've seen it once. A little bit of practice. And again, boy, I almost want to write paper 2 on this because it looks like there's some really good that one website I found, that was amazing website that actually gives you the history. So it looks like that's out there.
these bonds are on Bloomberg, so you can actually find them on Bloomberg and do the analysis of them, look at their histories. So there is quite a bit that you can do here. The problem with them is they tend to be pretty short term. These aren't 20-year bonds usually. And so they tend to come and go pretty quickly. But pretty important part of the business now. So let's look at this one. I give you the 3 scenarios. So they're going to issue 300 million. So you know 300 million is going to come in. So you already know that's the most money the insurance company is going to get out of this. So what are they going to lose if it's $1.5 billion loss? The most they can get out of the reinsurance is 300 million. So what's the best they can do with a $1.5 billion loss, do you think? It's gonna be 1.2. You already know the answer to that one, right? If all you get is 300 million, that's the most they can possibly save on this. All right. So that one you already know. On the first one, the attachment point's 800 and the loss is 750. So in the first one, they lose the entire 750 plus their premium and the bondholders get everything. So the second one's the only one that's a little tricky. And how did the bondholders do in the last one? They lose everything. So the first one and last one are really pretty simple. And it's just the second one where you got to do some calculations. All right. So you really already know I mean, assuming I give you this, and it's possible I could give you one that's doesn't use up the entire 300 million, but it should be fairly obvious on those first and third scenarios. So they can issue 300. It's 3 years. The coupon is 8%. But the most they can get on a 3-year treasury is 4%, and the attachment point is 800 million. So the first thing we got to do is figure out what this premium is going to be. All right. So step 1, what did they have to have at the end of 3 years to pay that 8% return? Everybody see that? And on the exam, it's closed notes. So you got to know this off the top of your head, but this is actually pretty good math because it's similar to other exercises. In fact, this is a pretty common approach. I do equity-linked annuities in my life insurance class. It's a very similar concept where you can say, hey, I need to have X dollars in a few years. I can get it doing this. You got money left over or whatever. You know, it's a pretty effective way to manage money. So we want to make sure we have 377 in 3 years. The problem is we don't get to make 8%. We're only going to make 4%. So how much will we need today to have 377? So you take that 377 and you now divide it. You take the present value at 4%. So you do the future value at 8% and you do the present value at 4%. So it's always going to have to be higher than the initial premium, the 300 million, because we got 2 different rates going on here. All right, everybody understand that piece of it? Are y'all getting the 377,914? Are y'all checking your calculators? Because you're not going to have Excel. You got to get it dust off that calculator and make sure you have it. I never use calculators hardly at all. So make sure you know where the key is. I have at least one student. I don't know how to get the decimals, and I don't either. So if a student comes and asks how to get decimals, then I'll just Google it and we'll find it on there. That's the only way I know how to do it. So you might want to make sure you're getting several decimal places. Yeah, I have a student. Yeah, I borrowed my roommate's calculator and it only goes out 1 decimal place. 3 is enough decimal place. I want, don't go wild on the numbers. Rounding is not an issue. I don't count off for rounding, so you don't have to go out 20 decimal places or anything like that. So make sure you're getting these numbers. Anyone confirm? David, you get that? Or anybody get that number? Cassandra, you get both of them? All right. Okay. Then step 3, Pretty simple. They brought in 300, but they need to invest 335. So Taylor needs to make up that difference, and that's their premium. And again, Taylor versus the trust, I'm being real sloppy in the answers. So remember, there's actually a separate entity here. So Taylor pays 335 into the trust. So on day one, the trust has 335,964. 300 comes from the investors, 35 million, 35.9 or 36 million comes from Taylor. And that's before you've answered anything. So you got to figure that out before you even start answering the questions. So you get that set up. All right. So the $750 million loss is pretty straightforward. It's below the attachment point of 800. So Taylor's going to pay that entire 750, and they're going to pay their premium. So they're going to pay 785,964. The bond investors, there's no calculation there. They make 8%. They're happy. They might have been worried 750 because they're not going to know it's 750 for a few days until all the losses come in, maybe for a few months. It can take a while. So they may be worried for a while there, but at the end, once all the dust settles, they'll be glad they made that 8%. So the first one's very, very straightforward. Now, should they be upset that they bought the insurance? It's just like with any insurance. If you buy life insurance, you shouldn't be upset that you didn't die. You bought it just in case you died. It's a low probability event. Same thing with reinsurance. These are very high attachment points. They shouldn't be collecting on these every year. They should collect on them like once a decade or so. It should be pretty rare. If they collect on it more often, they wouldn't be able to sell the bonds. So these are very, very rare events. Even with your auto insurance, how often do you file claims on auto insurance? Hopefully it's not every year. So you're buying, and we know it's a losing proposition anyway. And that's true, not just for you with auto insurance. It's also true for Taylor. When they buy reinsurance, they're expected to pay more because the reinsurer has to pay the claims and it's got to make a profit. So insurance is always an expected loss, expected negative net present value. All right, let's do the last one because that one's easy as well. 1.5 billion. So they're going to pay 1.5 billion. They pay the premium, but they essentially get the premium back because they just get all the money back from the trust. So they're just going to get the 1.5 billion minus the bond investors 300 million, and they'll end up paying 1.2 billion. And then the bond investors are going to lose 100%. So the only one we have to really do a lot of calcs on. And you can do that with your answer. You don't have to like write all this out. If you know it's a negative 100%, you can just write negative 100%, right? You don't have to write everything out. All right, so the 910 million, first off, you start off where that's 110 more than the trust, than the attachment point. So the trust is going to pay $110 million to Taylor. So instead of having 335,964, they're going to have 335,964 minus 110. So they're going to have 225.964 to invest at 4%. And so you get the future value at 4%. You notice on this part, I don't need the 8% anywhere. I only use that at the beginning. And so when you take 225 and raise it at 4%, you get 254. So what's the return? They're going to end up with 254, 1788. They invested 300. Make sure you use 300 here. Some students will use the 375 or the 335, but you're looking at it from the bond investors. They only gave us 300 million. So that's their investment. Take that to the 1/3 power minus 1. And so they lost 5%. Now, this is not, they didn't lose 5% in total. They lost 5% a year. They actually lost much more than that, whatever that is. 254 over 300 minus 1. So, you know, they lost like 17% or something, but the annualized return is negative 5%. Is everybody comfortable with this? There's probably about a third of the class that something wild goes wrong there. Some calculation. So just make sure you practice it. I got it. And then for Taylor, so they pay the 35, they pay the full 910 and they get 110 back. So they end up paying 835, 964. Now, could I, to Kenny's point, could I do anything for you? Maybe I would say extra credit. And what might the extra credit be? What's that question I asked y'all last time? Yeah, what is the rate online for Taylor with this policy? You may know how to do that.
This is the premiums divided by the coverage.
Yeah, so how much extra coverage are they getting here? You know, look back up at the first one. $2.5 billion. How do you get the 2.5 billion? Well, the extra coverage can only be what the bondholders invested. So that's pretty simple. So that's going to be their denominator. So what would it be in this case? Premium divided by extra coverage equal 35.964 divided by 300, so about 13% or so, 12%. %. And that's how they'll look at it, and they'll compare different ones. And I don't know how good my numbers are, so I don't look at rate online very often. So some actuary does this, like, are you crazy? That's way too high or it's way too low. I just don't know because I don't have that inside information on them. But they do know what this would be, and then they can compare it to what the reinsurer would charge. The reinsurer might charge, say, 10% or 9%, because remember, this is going to be more expensive. It doesn't have the credit risk of the reinsurer. But if the reinsurer is 2% and this is 12%, then they know, wow, it's just not really worth it. If it's 12 versus 11 or 12 versus 10, it's probably worth it because they get extra capacity. So I really love Rate Online, and I highly encourage you to think in terms of Rate Online as well when you're looking at different coverages. Because sometimes, you know, if the Rate Online is 40%, you're like, why am I buying this coverage? My word, I'd have to have a claim almost every other year for this to make sense. That's just really expensive. And if you think about life insurance, the Rate Online can be just a small fraction. If you're in your 20s, the chances of you dying is really, really low. So you're talking just small fractions. And so they look really, really cheap. And this Rate Online, I think, is really important. I have to do it when I do when we talk about parts B and C of auto, which I hate. One reason I hate it is it's so expensive versus what you get. I just think it's a terrible coverage, and that's what you're after. Because remember, insurance, I think the most important thing always remember is that you know you're paying more than you expect if you paid it yourself. Because the insurance company needs a cushion, they need profit, they have expenses. So you know it's a losing proposition. You don't want to overbuy insurance, and Rate Online is a good way of thinking about it. I don't know if any of y'all went home and priced your deductibles on your auto or your home just to see. A lot of people don't do that. Or I bet I have students that don't even know what their deductible is in their auto. I don't know. Well, putting that on the spot, but you know, if you don't even know, then you're paying money and you may be paying too much, too little, and then you'll go change it, and the next day have an accident, and then you be mad at me because it costs you $500 in deductible, but you're on your own. I'm not encouraging. All right, there's one other problem. You can certainly work it. Looks like the answer is in there, so you got the answer to all three of them. I don't remember when the exam is. gosh. It's coming up here sometime. So, maybe we'll work one last one from last year. And so you have one final one as a practice, but whenever the exam is, let's see. Because it seems really easy right now because you just did it, but then you have this break for I don't know how long. 3-6. So yeah, we got like 3 weeks. So yeah, you got 3 weeks. So the week before, we'll probably need to work it one more time, just to refresh your memory. But you have 3 problems there, and they're all the same. There's nothing. Let's just see if y'all can do it. A and B, A and C. On C, what is the investor going to get? Minus 100%. What is Roadrunner company going to pay? 800. You see that? You may have to do a little check, but first of all, 1.4 versus 9. There's 900 million in losses, which is more than they got. So you might have to check that first. But yeah, they're gonna have more in losses than the entire trust, more in compensated. So they're 900 million over the attachment point. Roadrunner only has 600 in the bonds, and so they're going to end up paying 800 million. You already know the answer to that one, right? You can go down and see 800 million. So you already know, and you haven't even made one calculation. You already know. And what does the bondholder get under A? What was A under number A, letter A? Bond will make 7.5%. You don't know what Roadrunner is going to pay, but it's going to be 450 plus the premiums. You already know that. So I mean, these are two of the questions you have answered pretty quickly. I think that's the last one I gave you. So we got 3 there to practice, and they're all very similar. So if someone were to do this as a paper, you know, your angle could be how have these bonds actually performed? Have there been any that have lost money? What have been the biggest losses? When did they happen? An interesting one is, and I don't know if there's articles out there. Who buys cat bonds? Most retail investors don't commonly buy cat bonds. Cat bonds are generally hedge funds, pension funds are real popular, and other institutional investors. Now, are there cat bond ETFs? I would say probably not. High yield fund with, now a high yield bond fund could have cat bonds in it, but I doubt there's an ETF that's just cat bonds. That'd be really strange to see, but it's possible. But those are the kind of angles you could take on a paper like that. So there's a lot of places you could go with this particular one. What's the current yield on these things? You could certainly, I think it'd be really exciting, because if you got into an interview, boy, it'd give you some advantage, is to find one of these bonds on Bloomberg and bring in all the details. So why is that be good? Well, if you don't have a Bloomberg account, you need one. If you have one but haven't ever loaded a bond, that would be a good experience to have. So there's a lot. Not I'm trying to force someone to write this paper, but I think it'd be a really interesting paper. And that's whether you're an actuary or finance. If you're an actuary, you know, understanding this alternative to reinsurance at a level that most actuaries wouldn't understand at all. Now, could you go as far as to say how much more are cat bonds than reinsurance? I doubt we could find anything on that. But, you know, with AI now, is Google using AI on their searches yet? Look at that. Chicago Fed, catastrophe bonds, primer and retrospective. Well, don't you want to just stop and read that now? All right, that's pretty interesting stuff. Yeah, this looks pretty cool right here. I don't know why the Chicago Fed would be writing about that, but yeah, pretty interesting. They say it pays the issuer. USAA would quibble with that. The cat bond doesn't pay the issuer, the reinsurer pays the issuer. It's, you know, it's the reinsurer that's doing all this. It's not the bond. The bondholders pay the reinsurer pays the, but so you can see how sloppy they are on this. But if you talk to USA, they'd be really clear. But yeah, I mean, there's right there. There's a great, and that's what you're looking for paper too, is you need one really great article that you can summarize and then do a little extra side research, or 3 or 4 kind of good articles that you can together. So it's not a research paper, but you do need some substance to write from. So you're looking for something like this, and this looks pretty cool right here. But why the Federal Reserve Bank of Chicago would care about cat bonds, I don't know. So it could help you, you know, as well if you're interviewing, say, with a pension plan. So HEB has a pension plan and they hire finance people. I think there's like 3 people in that department. Going to that interview and they want some interesting investment idea. You got to bring up something no one else brings up. You know, so say, I think we should buy Apple stock. It's like, okay, yeah, that's been done. But bringing up something like this is, you know, pretty interesting stuff. Gives you a little bit of an edge as an undergraduate student. So any questions on catastrophe bonds? All right, so let's go back and talk reinsurance. So a lot of time reinsurers, they're not called Swiss reinsurance company. You just see Swiss Re, Gen Re, Munich Re, Employers Re. And like I said, I love Swiss Re, one of my favorite companies. I have a lot of free stuff online. Unique in that, I mean, this is what they do. It's not like Berkshire Hathaway where they have multiple businesses. So Swiss Re is a reinsurer. If I were an actuary, this would be my goal. Work for a major reinsurance company like Swiss Re. Some interesting articles. So their customers are, you know, you have to ask, what is their webpage made for? So you're probably going to get jargon pretty fast because they're writing this mainly for actuaries at State Farm and Allstate. You know, this is a sophisticated firm. They're not going to try to appeal to the general public. So here they have something on climate risk, strengthening global cooperation. You know, there's some interesting perspectives that just from the standpoint, what does a reinsurer focus in on? And what do they actually, you know, what do they research? So they have research. I love firms that publish their research for free online. Pretty cool. Hedge funds will do that. Reinsurance companies love to do that kind of thing. Even AIR and RMS, the cat modelers, do that kind of thing. It's pretty cool. There's someone out there doing this and writing on that kind of thing. As far as careers, are they hiring actuaries? They have a graduates program. So it sounds like they want you to work there. Question is, where are they? Do you think they have offices outside of Switzerland? Well, most likely, I would think. They have interns. You can meet their interns. So if you work for them, you'll get your picture on their website. There's Munich, Mexico City, Zurich. I don't know if that's where they're from or they're working. Wow, my word. If you work for them, you're going to like be famous. All right, so there's your goal. I want to show your picture to a class in about 4 years, but I'd be really impressed. I've never had a student work for Swiss Re. Our locations have offices in the Americas, New York, obviously, Mexico. So yeah, if you have language skills, that's the other thing. You know, they have offices in Mexico City. They probably want a Spanish speaker there. I've had several students get jobs because of a language they're fluent in another language, or Portuguese or French. I don't know, what do they speak in Toronto? Boston. What do they speak in Georgia? So yeah, I mean, this is kind of firm. Would they hire some from UTSA? I don't know. Why not? Did they hire finance majors? I don't know. I don't know what job they have, but really, really cool. So that's Swiss Re. Munich Re. You would think that would all be in Germany, in Munich itself. That's probably where their home office is. But again, another website which probably has some good research that you could do for paper two if you're trying to find that kind of thing. So careers, again, job search, areas of expertise, tech, obviously underwriting. So underwriting will hire finance majors. If you're a finance major and you're just so think about this. So sometimes you're 20 and you got 50 years here to go. So I was telling my previous class, I have students that like, what do I do the next 50 years of my life? You don't have to worry about that. You just gotta figure out the next 6 months. But finance is really interesting in that finance pays a lot for a specialization. And there's probably no better way to learn the insurance industry than go be an underwriter for a few years and then come back into finance. And well, you're set. Something you can't learn this anywhere else. You're not going to go to JP Morgan on the sell side or buy side, and they're going to teach you about insurance underwriting the way you're going to learn it working for a firm like this. So, I mean, it's just pretty cool. There's corporate functions. So there's where they have actuary, obviously. Corporate finance, that's where the accountants and the finance people would be. So, I mean, it's exciting. I was telling my previous class, I mean, that's what it's exciting is you have no clue what you're going to be doing. But once you get started 3 years from now, you're going to be a radically different person. You're going to know stuff. It's going to amaze you. But your fear is that you don't know what that is. But you don't have to worry about it. You just gotta step into it when it comes and be ready to go. General Re, I doubt they have a website, but they might. We'll see. Yeah, in general, I probably have to put the entire reinsurance in there. Meet Gen Re. So they do have a website. So they're part of Berkshire Hathaway, so they have that as well. They have careers as well. So the advantage here of working for a reinsurance company is you're usually talking about the top-notch actuaries in the field. It's kind of the ultimate place you want to go. They're dealing with massive amounts of money and they're dealing with the most complicated types of risk because you're talking about things that happen once in 500 years. Data is your problem. You don't have much data. You're talking about earthquakes that haven't hit in 3 centuries that are going to hit in Kansas, and understanding that they probably hire meteorologists, they probably hire engineers, they hire people that understand structures of buildings and those kind of things. So it's pretty interesting stuff. And they do more than just property side. So they probably have reinsurance solutions on the life insurance side as well. So very interesting field. If I were an actuary, I would be studying my sights on that. I would be applying to these firms just to see what the interview is like and see what kind of questions they're asking. I think if I were an actuary too, interviewing for a Swiss Re or Munich Re, just going to a UTSA or State Farm and saying, well, I interviewed with Swiss Re last week, I think they would be pretty shocked at that, just to say you did it. So, so they are an insurance company, but extremely high deductibles. So they tend to make a lot of money for several years, and then they have one really big hit. They're very much rate online type of. They talk about that a lot. That's a big part of them. They're very much probable maximal loss kind of stuff, modeling, looking to tells. Tail risk is a big thing to them. That term means a lot to them. They look at the tail of the distributions. We already did rate online. And then they have all these layers. And this is where I wish I could show you I'll show you the ones I found, but they're not as good as I like. But so a UTSA is going to have like this patchwork of reinsurers. And it's not going to be real obvious because you've got so many things going on. So you might have an aggregate reinsurance that's going to cover you for hurricanes, but then Hawaii has a hurricane state fund. And so your reinsurance is like, well, where did the hurricane happen? What happened in Hawaii? Okay, well, that changes things because now you got the Hawaiian fund, or you have the Florida fund, or in California, you have the earthquake fund. Texas, you have the fund. And so your reinsurance, you say, well, that's our reinsurance, but it depends on the event. So it depends on what state the event happened. Was it a hurricane or was it an earthquake? And so it can get really, really complicated. And that's why I couldn't find a good one. I wanted to find one that was as complicated as the ones I saw at USAA. And it was just like, here's our chart if it's a Florida event. Here's our chart if it's a Hawaii event. And it just gets really complicated. Well, what the scheme shows you are your sources for different type of coverages. And so how do you know what is optimal? And this is where we got really excited at USAA is let's run a million simulations with different reinsurance programs. And let's look at our PML before reinsurance and our PML after reinsurance, and let's compare that to the rate online. And what we're trying to find is the best bang for the buck. We're trying to get that PML as low as we can without spending a fortune. And so that's talking to Kirby, who did this at USAA. Boy, it was exciting talking to him. He was just, this is at a time where we just didn't have the computer power yet, but we were getting there. And his mind was just like, wow, we can do some pretty exciting stuff here. So let me show you a chart, at least the ones that I found. So here's one. Oh man, it's hard to see, isn't it? But it'll look something like this. You have this kind of stack pattern kind of thing. And what it's showing you is your loss amount. So you might say, hey, if it's below this amount, we pay for all of it. And between here and here, we pay 60% and reinsurance covers this. Up here on this layer, reinsurance covers everything over 500 million. Or maybe this is one reinsurance, so it covers from here to here. And then at some point, we're 100% coverage. So once we hit 7 billion, we cover all of it. So you'll see something like this. Don't you wish I could show you an actual real life one? But so I don't know whose this is. But you get these different layers. And then you have to renegotiate these every year. So that's why the math is so complicated, because it just keeps changing. If you had some major event like Hurricane Maria, well, the reinsurers are probably going to charge more the next time. And then you have to redo all the math to try to figure out, hey, should we do it at the same level? Should we do more? Should we do less? There was 1 year State Farm just canceled all its reinsurance. And then there was a big event. Whoever made that decision may have gotten in a lot of trouble because they decided we're just not going to do it. And that's pretty dangerous. You have these co-insurance where you're paying part, they're paying part, those kind of things. So it gets pretty complex. Here's another one, looks very much the same. So you see how I can't explain theirs because they've got jargon in there. They talk about reinstatement. So what the reinstatement means is if we have a claim, we have some guarantee that we can roll the policy forward. And so, that's kind of, you don't want something that the second you have a claim, they cancel you. You're like, okay, we got this claim and now we don't have any reinsurance. What do we do? So you want to make sure you have that kind of thing in place. But just, you can see how this is Allstate here. You can see how complex this can get. What does the word retention mean? That means they're retaining all the risks. So at 500, up to 500 million, Allstate pays all of it. Between 500 and 750, they start sharing it. And then different ones have different levels. Why are there two columns? Where you'll see this a lot. They're kind of asking first event, second event. Sometimes it's going to be different states. At least gives you an idea of what it looks like. So if you're an actuary that does this would be your entire job. You would think it might get kind of boring at certain times of the year because you're going to do this really heavy for 2 or 3 months. And then why do you do all the rest of the year? But you're going to be running CAT models. You have to look at that. There's different things you can do. But yeah, there's probably times in the year where you're going home early and there's other times where you're working pretty. So you're looking at the CAT models, and this really is, there's no way you can sit down and write a quadratic formula that's going to tell you the optimal solution. It's just too complicated. Your only solution really is to run multiple scenarios. And the frustration is going to be, wow, we had a $3 billion hurricane. Oh, it was in Hawaii. Okay, well, then we need this. It's that specific. You have to know exactly which, you can't just say how much the event was and what it was. You have to say exactly what state it hit. These tend to be very expensive, but they eliminate a tremendous amount of risks. So the impact is on the PML. You bring that PML down. Balance of the, you're trying to balance risk and return, but really your return, to me, return is, and return and risk is the cost versus your PML impact. And that's really the way you're focusing on this. And then there's two terms. We've covered both of these, but let's just refresh our memories. Probable maximum loss versus maximum probable loss. So you can see actuaries are real weird people. From maximum loss, the maximum loss that an insurer would expect to incur on a policy. They didn't give enough information at some risk tolerance. Maximum problem of loss. I don't know what EML stands for. Estimated maximum loss, but so it's actuaries are real picky when it comes to things like aggregate versus specific to an event. Is it annual? Is it an event? Those kind of things. So they get real picky on the calculations, and it means something to them. If you take the actuarial exams, probably a lot of these things are on the. So there's one I just learned today. I've never heard EML before. So why is this all important? Because that's when you're going to assess the pricing and what you're looking at, what risks are actually covered. So they can be per occurrence or they can be aggregate. So aggregate just means, hey, anything over $3 billion in the your entire book of business, we cover everything between 3 billion and 3.5 billion. Or it might say any hurricanes in Florida over $1 billion, we cover that. So it's just specific to that particular event. All right. Could there be a paper on reinsurance? I'm not sure. It's been a challenging industry. Y'all probably have heard of Employers Read. Y'all remember Employers Read? Who's it owned by now? So it used to be owned by GE. Is it still owned by GE? So y'all know GE's been really struggling. Why is GE struggling so much? Well, they probably shouldn't have gotten into financial services. They probably shouldn't have gotten into insurance. So GE, you know, they still make good plane parts and plastics and all those kind of things, but this is where they messed up. So Employers Read somewhat implies it's more workers' comp kind of stuff because you have that word employers, but it's a major reinsurer owned by GE. So they're out there. I don't know if that's the one you want to work for, given they've had some issues. All right, that's homeowners insurance. I think I gave you out on our website. Yeah, up here, TDI, the Texas Department of Insurance. If you go to their website, they have a lot of stuff for policyholders, not for corporations. And so what they do is they tell you what you as a homeowner should know about your homeowner's insurance policy. And the nice thing about it is it's specific to the state of Texas. So if I type the word mold coverage is going to come up. And it's going to talk about mold coverage from the state of Texas standpoint. So that's why it's helpful. It's not the general stuff I've been talking about. A homeowner policy automatically provides $25,000 in coverage. So if you're interested in that, you can get up to $1 million. After $1 million, you're going to do an umbrella policy. So you can get more than $1 million, but not under your homeowners. We talked about the different HOAs, so that's still in place and what they cover. What losses are covered. If you live on the Gulf Coast, you might receive an endorsement that includes coverage for wind and hail. What does that mean? Then you have to go to the Texas Wind Pool. You have to buy your wind coverage from them. It doesn't mean you're not insured. It just means you can't be insured by State Farm and Allstate. Most policies would not recover mold remediation, so there's a mold issue. A lot of this stuff is brand new since the Baldwin family came in. Insurance companies are required to offer remediation coverage, and you see the different pieces there. Texas law requires insurers to pay the full amount of the policy, even if this amount is more than the replacement cost. Replacement cost is different from market value and does not include the value of your land. Remember, we said land is not covered. HOB policies automatically cover household contents. Companies generally want you to prove that you replace an item before they'll pay your claim. Making an inventory will help you decide how much insurance you need. So, yeah. I know so many people, they don't want to do that because they're going to say, if I do that, I'm going to discover it, I don't have enough coverage, and then it's going to cost me more money. And it's just not the way to think about insurance. If that's the case, don't buy insurance. It's like, I don't want to pay more. I don't want to pay as much as I need. I'd rather risk it that I never have a claim and then I'll find it out at that point. And it's like, no, that's not, you should just not buy the insurance. Your inventory should list each item, its purchase date, no way for me. Value and serial number, no way. Photograph or videotape each room, including closets, open drawers, storage buildings, and garage. Keep the inventory receipts for your major items and a fire. No, don't even do that. Take pictures of them and put them out there in Carbonite or whatever. You know, you have these offline sites. Yeah. Well, first of all, have you priced a fireproof vault in a while? They're not the cheapest things in the world. Fireproof vault. They're expensive. Really, really good one. $700. Do you really want that in your house? And they're not fireproof. They're 90%, you know, there's fires that are going to destroy this thing. So I would say take pictures, take videos, and put them out there in the cloud somewhere. That's going to be far better. If you have expensive documents, put it in the vault at the bank. So I don't know how much a box at the bank, what do they call them? A safety deposit box, how much they cost, but it's, you know, you could probably pay several months of that with the cost of the safe. Do any of y'all have fireproof? None of them, make fun of them, do you? Really small. So yeah, probably, you know, those look like they're not quite so expensive, but I don't know how fireproof that is. I don't know what they tested. They'll probably tell you for $36. But yeah, I've gotten more and more of just getting everything, putting it as a PDF and putting it out there on my Carbonite. And I feel much more comfortable with that. Videos and pictures, it's just really very valuable. Texas ranks near the top of the nation in weather-related property damage each year. A large portion is flooding. The Texas windstorm, the TWIO we talked about then, insurer of last resort for wind. When a hurricane enters the Gulf, you can no longer change or purchase new windstorm. That makes sense. The same thing with flood. If you don't have flood, you know, you got a 30-day wait period. So make sure you don't say insurance is not something you say I'm going to buy it when I need it, because the insurance company is not going to sell it. It pays to shop around. Absolutely. That's far more important than life insurance, but it is true with auto and homeowners insurance. I usually recommend at least every 5 years, go out to 5 companies, go out to the big players. It's competitive. Life insurance is not competitive, but property and casualty insurance, they all know what each other is charging, and they're pretty competitive to each other. So they're not going to be way off. So if you have the big guys, State Farm, Allstate, Farmers, UTSA, I've left someone out, Hartford, you know, go out the 5 of them and just see what you can get. There is something called Esurance that Allstate has started. So you can there are some online sites where you can put the information in. It gets tough because there's so many different combinations of coverage. It's hard to get true apples to apples, but there are websites that you can go to the shop. So I would do that. I wouldn't do it every single year, but every 5 years, you could certainly do that. Choose the highest deductible you can afford. That's not what I recommend. I say calculate your rate online and try to see where that break point is and choose wisely. You can see they show you some websites that you can choose. Shopping for home insurance worksheet. Help insure, I don't know if this site still works. We can try it. You know, if the state's recommending it, you hope it's not somebody's, you know, tied to some insurance company. Find and compare home and auto insurance policies in Texas. Auto, this looks like a pretty decent site. Might be interesting. Texas law requires rates for insured to be reasonable. Yeah, we've talked about this. Reasonable, adequate, not excessive, not unfair. We're about to get into this heavily when we talk about auto insurance and credit scores. So what's the difference between reasonable and not excessive to the risk? Adequate means high enough. Not excessive mean not too high. Unfairly discriminatory, we'll talk about what does unfairly mean, because insurance is somewhat unique where they can discriminate on age and gender. You know, you try that with HEB. Oh, you're 60 years old. We charge 60-year-olds more than 40-year-olds. We just don't like old people. And try that. But insurance companies can do that. Not because they don't like them, but because they're maybe bad drivers. But what's unfair? So there are discriminations that are illegal in insurance. And so we'll talk about that when we talk about credit scores. So Texas is following use. So you don't have to get approval to charge, but the state can come back and disagree. However, anything you price in your policy has to be actuarially sound. So you can't say, you know, brown-headed people, I had a cousin who had brown hair and boy, he irritated. We're going to charge them $50 more. No, you have to prove that either frequency or severity is higher. Now, could you charge brownhead more than blonde? You probably could. I don't think that's illegal, but I doubt they drive differently. And we're going to talk about this. We're going to look at the list of the things you can price, and look right there. Credit score is in there. Talks about the discounts you can get. Most insurance companies have the multiple coverage, so auto and home or multiple cars. You get the discounts for that, and that usually works. There's help insure again. We talk about these fair plans. We won't get into those, but for people who just can't get insurance, so there's some interesting stuff in there. All right, non-renewals. When can a company say we're not renewing you? If you move out of your house, it remains vacant for 60 days. Most policies automatically suspend coverage for damages, so you might want to know that. A company cannot unfairly discriminate between individuals of the same rate class. So you can't charge people that are essentially the same frequency and severity. You cannot change them, charge them different premiums. So based on sound actuarial principles. We'll definitely be getting into that. Yeah, some pretty good stuff there. So someone in the state of Texas is doing some good analysis. So there's your homeowners. So now would be a good time to take the policy out and go through it, see what your deductibles are, what you're paying for. Do you have HOA, B or C? Do you have any coverage at all if you're renting? I don't know how many of you renters. And I do strongly recommend, if you're a renter, to at least go price it, because you will be surprised how cheap it is. And it does cover some stuff you might be surprised about. But yeah, go look and see what you have. Look what your deductibles are, see what your choices are on that. If you're worried about mold and those kind of things, look into it. If you don't have flood and you're just assuming you have flood because you have a policy, go and see what kind of flood could hit your area. All right. Any final parting comments on homeowners? So you're in did you know you're in one of the most expensive states for homeowners? Any of y'all move from one state to Texas and go, what? My rate does what? Are you kidding me? And Bexar County is one of the most expensive states for auto, probably for homeowners too, because we have a kind of a theft issue in Bexar County, and more than maybe other places. I don't know, versus Austin, what it is. All right, let's just quickly start auto. We won't get fully through it. But the personal auto policy. So most of y'all have this. In fact, in Texas, you don't really have any choice, at least for the liability, you have to have coverage. So first of all, what is a covered auto? So this can get really tricky. obviously you own a car, you have it on the policy, that's covered, but what about other cars? What if you go out and you buy a car and you forget to tell the insurance company, but your other car was covered? Well, then you're usually covered there, but you got to be careful on what limits or whatever other things you have on that. And when I bought a car, I forgot to tell the insurers, or I called them and he said, yeah, you bought a car yesterday, you bought this car and this is how much you pay. It's like, wait, how did you know that? It's like Big Brother is watching me. So they already knew all of that. And there's like, we already updated your policy. So that's great. I guess, and I don't borrow money for cars, so it wasn't the credit union. So I don't know how they knew. So what if you get a third car? So you're still covered, but you better let the insurance company know pretty quickly. What about a rental car? We'll talk more about that. What my advice on rental cars is call your insurer to make sure, especially if you go out of the country. Don't go to Mexico and rent a car and assume you're covered. There are countries that US insurance is illegal. You have to have Mexican or we discovered this in Costa Rica. I was so shocked. We rented a car for a few $100s and the insurance was almost twice what the rental car was. So it's just it was more than the rental car. The rental car was really cheap and the insurance was ridiculously high.
Did you buy it?
Huh?
You said you bought it?
Well, we don't have any choice, so I couldn't use my US insurance. But the question you always have is, well, what is this covering? What if I have a liability exposure? Does my US cover me at all? So that's why when you're gonna have a trip, we made a mistake. We went to Europe once and we were in Greece and auto insurance there was really, really expensive. And we just didn't know. We didn't know if our US covered us or not. We should have made that phone call before we left. So if you're going to go to Europe or any place and you're going to rent a car, I would call your insurer and say exactly what I do. Now, sometimes your credit card will have you some coverage. So those kind of things you want to check in on, but just don't assume. It can really mess up your trip. If you're sitting there at the counter and you're like, okay, that's going to be $600 for insurance and you have no clue, it's frustrating. All right. The policy format is the opposite of homeowners. It starts with liability and then goes to property. Why? Because liability is a bigger issue for auto, and for homeowners, property is the biggest issue. The preliminary section is essentially the same as as homeowners. So part A is liability. Part D, see, I'm going down several pages here. Part D is your physical damage. So what's all that junk between A and D? And that's the stuff I don't have, but all of you do. So we'll have the debate. Would y'all like a really true debate? Should I call State Farm and have them come in? Wouldn't that be cool? Should I call my lawyer friend he's a personal injury lawyer and he does BNC, so have him come in? He's a really smart guy. He's a really good violin player too. We used to play concerts back in the day. All right. So liability, very, very important on auto insurance, but this is when the state gets involved. And the state's going to dictate, but every state's a little different. And so, and this is what drives B. So when you look at B, or C, excuse me, we'll look at C, uninsured motorists. You might say, well, obviously I need that because there's uninsured motorists. Because what if an uninsured motorist hits my car? Well, you got D. That's going to cover your coverage there. So what is C actually covering? And so that's what we're going to have to debate. What is it covering? I'm going to argue I've already got coverage for C. I don't need it covered again. My lawyer friend's going to say, but not everything. And he lists all the other things. I say, but I don't care about that. So there are things C covers that I don't have coverage for, that I don't care about, that you might care about. So that's what we have to figure out here. But my point is, I bet a lot of you've never thought about it. You just bought it because you bought it. So you want to at least think about it, don't you? If you're spending this money, you're spending a few $100s on this, you want to at least figure out what you're spending money on. B is health insurance. Don't you have health insurance? Why are you buying health insurance in your auto policies? So that's what we're going to get into. The reason A is so long, and I'll probably skip through some of this, is to get into some of the issues with how different states handle the liability side, which I don't think is all that important. So we're going to somewhat skip through that. I just want you to be aware different states have different rules. Do they require you to prove it in advance? And I think now states are getting more sophisticated where, you know, it's illegal not to have it, and police can find out pretty quickly if you have coverage or not. You know, it's just it's getting much more automated. All right, so B then is the medical payments. We'll talk about why we're doing that. C, uninsured and underinsured motorist coverage. We'll figure out what that covers. That's probably the most important thing. And this whole idea of no fault insurance, which was huge in the news. And there it was being pushed at the federal level. We'll talk a little bit about that with some really bizarre political enemies joining teams.
Like they say, you know, they're gonna lend you a loan, they wanna make sure you're insured so they can protect themselves, right? I guess like the same thing with. Why do they force you to have auto insurance? Is that why, I guess, just to protect yourself or to make sure?
Well, you don't have to have D, you have to have liability in Texas.
Right,
And that's just the social contract that if you're going to be driving around, which is the most dangerous thing you do, and you're going to cause other people damage, you better be able to pay for that. And so that's what the state is saying. You got to have the insurance.
I thought it was because it's the car company's gonna loan you or the bank's gonna loan you, they wanna make sure that you're safe, you know.
Well, that's more part D.
Right,
They want to make sure if the car gets wrecked and totaled.
not just because it's for your own good, but.
I don't think banks care if you have part A so much.
Make sure if you have full coverage to ensure that they'll make their payment whether you have the car. or not.
Yeah, part D is really important then, but I don't know, do banks care if you have part A? I mean, you have to have it for law, but I don't think because you're damaging someone else's property and they're like, we don't care. They don't owe us any money. But they definitely want to make sure if you have the same thing with your house, they want to make sure if your house burns down, you're going to pay off the mortgage. All right, so we'll talk a little bit about no fault, but yeah, no fault. Graham and McGovern were both, I mean, I don't know if y'all know either one of those. I forget Graham's first name. Anybody remember Graham? He was a Texas senator. Is it Phil Graham? Boy, I can't remember. And McGovern, y'all remember McGovern? No, you don't. Anybody know who McGovern is? He ran for president against Nixon. He holds the record for losing the most states in a presidential election. I love McGovern. I think he was the greatest guy. He's so nice.
That was Mandel versus Reagan.
That might be in the popular vote, but McGovern lost 49 states, I think. I'm talking about middle school here.
Right.
Was George McGovern? I don't remember how you say. I'll have to look it up, but I think he lost the most states, but I don't know. I know, yeah. What you're talking about, Reagan's second election? Yeah, that was a pretty big loss as well. I love McGovern. I thought he was just such a nice person, but that may have been why he didn't win, because he's running against Nixon. He wasn't quite a nice as a person, and so it was kind of an unequal battle. But Senator Graham and these two, this far right, far left, they came together on this issue. We'll talk about why they thought no fault was such a great solution, and at the federal level, which is pretty important. And then we'll get the coverage. I mean, property side, collision, which includes some stuff you might be surprised it includes, including your rental car coverage in there. So these are things. So there's a lot of notes in here we're going to skim through, and then when we get to the medical and uninsured, I'll see if I can find someone that'd be willing to come debate me on this. I mean, Damien, you may know somebody. Anybody in your office that would?
Life insurance now, but I used to write, into.
You probably know some. You probably.
I was a sales agent. It's not like.
Yeah.
The way I
You,
look at it is how much risk can you avoid?
well, and so it almost gets back to right on line. What exactly am I getting with B and C? And that's what I ask insurance. Let's go through scenarios. An uninsured hits me, hit and run. My car is on the side, so I need a tow truck. Got damage to my car. How much does D cover? It covers everything above your deductible. So you're out the deductible. Okay, I got a rental car deductible. I got serious neck injuries. Okay, you got pain and suffering. Okay, so you're going through all that scenario. That's what I do with insurance companies. Give me a scenario, an extreme scenario, and tell me what's covered and what's not covered. That's how I understand insurance. And so that's what we're going to do. What is covered, what's not. And then I'm going to show you some debates from online who says you should never cancel B and C. And I'm going to show you their arguments, which I think some of them are a little squirrely. So we'll get into that. I've never been successful in convincing a class my side of the argument, so I'll lose with this class as well. But anyway, I'll give it my shot. All right, we'll start here next time. Any issues you have with the paper, give me a call. Come by tomorrow. I want you all to do well.